to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good morning, guys. I am Nick. So the big news is the CPI data. We had some much better than expected CPI figures from the US last week, powering the S&P 500 up by 5% on the day. That's the biggest jump since March 2020. The Nasdaq even more, up 7%. But we'll chat a little bit more about the inflation outlook and the outlook generally for the markets and the economies a bit later. But the two schools of thought, and I referred to this actually in the weekly market report yesterday, the one that we send out to clients and potential clients. And one is that the Fed has done enough. Inflation's going to come down far more quickly than most people expect. Equally, bond yields and interest rates won't need to go up by as much as expected. And that all sounds very good for the markets. But although it is probably good for the markets short term, maybe over the next 2 or 3 months, eventually there'll be a recession. And that recession will cause the markets to drop even further at a later stage. The good news is that once that recession is over, and it'll probably only be a mild recession, the markets will then rocket as the Federal Reserve and other central banks start stimulating policy. The other school of thought, and this is the MRB school of thought as opposed to the capital economics one, is that the Federal Reserve has not nearly done enough. Yes, inflation appears to be peaking, appears to be dropping, which is a good thing for the markets for a period of time, but inflation will be sticky due to wages, services. Yields will come down, but later they will go up again, and prescribed interest rates from central banks will go up as well. So that school of thought leads us to believe that markets are going to be very strong, probably until the middle of next year, and then decline sharply once more. So what is the OAM strategy? We are buying, we're enjoying the seasonal rally. Luckily, the purchase of JP Morgan American was before that very good CPI number, so we have a good entry level on that share. You might think, well, should we really be buying after markets have jumped? Yes, we should, particularly Europe, which is so cheap and offers such a good opportunity. There's a seasonal effect. Normally, this period of time is very bullish for the markets. There's also the impact of the midterm elections in the US, which always tends to favor risk assets. But we are mindful of the risk that there will be a recession next year, and markets always drop when there's a recession. After we've enjoyed the rally of the next month or two, we will rebalance using the rally for its tactical advantage and sell out possibly from one of the weaker holdings in the portfolio, is most likely one of the UK holdings, because if there is going to be a recession, it'll be steeper, most likely in one of those weak link economies like the UK, Australia, Canada, New Zealand that we've been chatting about for some time. Let's look then at this inflation paper by Capital Economics, and it explains why they believe that there is a recession just around the corner. And then I'll be quoting here Neil Shearing, Group Chief Economist, Capital Economics. Economists and by extension central banks understand less about inflation dynamics than we would like to admit. They can be fairly sure that headline inflation rates will fall over the coming quarter, even quarters, as this year's energy and food price shocks start to drop out of the annual comparisons. But the key for central banks is knowing how far inflation will fall and for how long it will then stay there. On this, they can be much less certain. A lot will depend on what happens to labour market conditions and wage setting behaviour. This is highly uncertain. The best we can say is that there's been a modest loosening of labour market conditions in the US and UK. It's extremely difficult to judge how wage pressures will evolve and how seriously central banks should take the threat of a price-wage spiral caused by de-anchoring of inflation expectations. One consequence of this is that central banks are putting less weight on their forecasts and more on actual inflation. There are two immediate consequences. First, without the conviction of a model or a set of reliable forecasts, it's unlikely that central banks will be able to accurately flag a peak in rates, much less a pivot in advance. And second, since monetary policy operates with a lag, putting more weight on actual inflation rather than the likely future path of inflation raises the risk of over-tightening. So I think that explains their view. And their view is as follows, just a few bullet points, sound bites that I want to share with you. The Fed's mood will ultimately shift if, as we anticipate, core inflation continues to fall and the US economy slips into a recession. That informs our view that by the end of 2024, the Fed funds rate will be far below what investors are now discounting. We forecast the 10-year Treasury yield to fall to 3.25% by the end of next year and 3% by 2024. So while equities received a boost from lower real safe asset yields, and we think this tailwind will persist, we still expect it ultimately to be more than offset by concerns over the economic outlook. Their forecast for the S&P 500 is to fall from the current level of 3,900 to a trough in mid-2023 of 3,200. Markets down and then they go up. With MRB, it's different. Markets go up and later they go down. So luckily we have very diversified portfolios that are suited for all weather conditions. So the bullets from MRB, the pause in the cyclical bond yield advances underway, providing relief for all asset markets. US inflation pressures will ease for a time, but a return to the 2% world is not on the cards unless growth is much weaker than we envision. The main bearish force for equity markets this year, intense derating pressures, have recently dissipated, and the recent softening in the US dollar has been supportive of a better global financial market backdrop. But inflation and wage demands are likely to prove sticky absent a full-blown recession. This is not just the case in the US, but also true in many developed market economies to varying degrees. So while US and global growth could be soggy in 2023, we do not envision a cleansing phase and a reset for the global economic cycle. In fact, we anticipate growth to be better than is currently discounted. The corollary is that there is unlikely to be sufficient slack created that would curtail consumer price inflation by as much as expected by investors and central banks. We anticipate another upleg in yields in 2023 with knock-on effects on all asset classes. Now we're looking at the outlier, Europe. We've spoken about it before. It's an opportunity for investment. These are views from MRB partners. The US and the Euro area economies should prove more resilient than expected in the months ahead. This bodes well for the financial sector in both markets, but favors most the Euro area risk assets relative to their US counterparts due to valuations. US and Euro area households, businesses, and banks are in solid shape, which provides a much greater foundation for these economies than a decade ago. the risk of a US or a euro area and aggregate global recession has risen, but is not yet as elevated as generally perceived. So onto the politics. We all had Trump has put his hat back into the ring for a race in 2024, which is exciting, always entertaining. Let's discuss the midterms and the implications that they have for the markets. So this is research from ECR. There was frequent mention of a red wave. However, events do not seem to amount to much more than a political ripple. The Democrats fared considerably better than expected, and many radical candidates on the side of the Republicans lost. As the Republicans have at least got their hands on one chamber of Congress, a period of gridlock seems very likely. The usual rule of thumb is that a divided Washington is good news for equity markets. What is the statistical empirical evidence? Well, ever since 1950, the S&P 500 has always risen in the year after a midterm, regardless of the party in power. And when it's a gridlock, it's even better. Ever since 1950, the index has consistently shown an outperformance in times when there is a Republican-led Congress and a Democrat White House. So the annual average there is 17.5% gain in the S&P 500 versus 12.3% in an average year. And then finally, just a summary, really, equity strategy, asset allocation outlook from JP Morgan's Cazenove. They've been bullish for a time. We reiterate our call that equities are helped by the likely peaking out in bond yields and a turn lower in inflation. These will lend support to PE multiples. This goes along with still record negative investor sentiment, light investor positioning in the markets, supportive seasonals into year-end, China reopening, and the likelihood of smaller than typical earnings contraction.
Hi, Nick. Thank you very much. Very interesting for me, this views on inflation, economy, and the markets. Locally, there's not a lot of figures that came out. ABI, we own it. Not a very well-known company, but it's a big company, not so well-known as Pick n Pay or Dis-Chem, but it's the same size. The sales for the quarter, they ended September, increase was 9.7%. That's year on year. It was strong results driven by price increases. They could increase their prices. It was a decent update. The sales and profit margins on footwear and apparel continues to improve. Sales growth was achieved in all categories except I&J. They own I&J. And I&J was impacted by poor cash rates and the unfavorable abalone sales mix. Transaction capital reported for the year ended 30th September. It was also a decent update. They had an increase in HEPS of 17%, and there will be a dividend of 70 cents per share, an increase of 33.3%. It's not bad. It's interesting that transaction capital, they've generated shareholders' returns over the past 10 years at a rate of 28% per year. That's a compounded annual growth rate was 28% per year. That's not bad at all. And also interesting, in the 22 financial year, it exceeded its target of selling 10,000 vehicles per month. In the last 3 months, they actually sold 12,000 vehicles per month. And then on the statistics side, production is a big job creator, but it's also a big creator of strikes. The gold production was down 12%, and the mining production, this is for September and it's both year and year, was down 4.5%. It is the 8th consecutive month of falling production for both the mines and the gold industry, and production was hampered by strikes and by ongoing load shedding. Manufacturing production is much better. It was up 2.9% for September year on year, and it was the third straight month of increases. The largest contribution came from the manufacturing of motor vehicles.